Well, we had an excellent quarter across every business and every metric. It's a record. It's the 13th quarter of profitable growth. And very simply, we're getting more confident on what we can get this year, and we're getting ahead on our plan of accumulating profit during the year. In addition to that, we have had a positive surprise on systemic charges. They are 200 million better than we expected. So when we combine all of this, we are confident we can exceed 8.5 billion and eventually exceed it by a significant amount.
So revenue came above expectation, 6.3 billion. So NII was 3.6 and fees 2.1. And I know you've said in the past that you'll be able to offset the effect of lower NIIs going forward with lower interest rates because of your fees going up. And the chunk of the fees is higher than the last quarter. But how confident are you that you can carry on with that momentum going forward?
Well, as you said, firstly, NII was stronger than expected. Good. And that shows the resiliency of what we have built. But most importantly, in terms of top line, fees started performing at the level that we're expecting. This is a little bit of a vindication of all the investments and all the build-up and all the training that we've done for people on the fee area. So simply put, we think we can absorb a significant portion of the headwinds coming from a normalization of rate and the normalization of a risk cycle with what we have put in place, which is not only about fees, it's also about our efficiency, it's also about our capital efficiency, it's also about all the building blocks in the P&L. So clearly at UniCredit, we are quite excited to see what will happen when rates normalize, cost of risk normalize, and there will be a big differentiation between banks who have built for the future and banks that have not. For us, we're really confident that we will be able to absorb the hit and continue performing well in the next 3 years.
So you think there'll be a moment where your strategy will show off at that point when it's not about NIIs anymore, it's about the fees?
Well, I do think that the impact of rates and a very benign cost of risk has a little bit drowned everything else. It is so significant. And it has not allowed to see through what exists or what progress there has been in the last 3 years. And I don't think all the banks have done the same progress. Some have only benefited to the extreme from NII and low cost of risk. Others have built to be ready for when that would pass. And I think we're in the second category.
Just to stick to rates, of course, now inflation finally softening here in Europe. And there's the view that the ECB will start cutting earlier than the Fed, where it looks a little bit stickier. Some economists are concerned about the divergence in the rate policies and rate direction between the two banks. Is that something that concerns you?
No, I don't think so. I think the ECB has been relatively clear that they will start dropping rates in June. I think it's justified by the direction of inflation and the numbers. The question now remains how fast and how low and by when. And I think that's the key question. But I think that we've said that before, the performance of the economy and the inflation numbers of Europe versus the US are different. So while nothing is ever certain, it makes sense that there is a bifurcation of the two rate cycles.
And so on the macro picture here in the Eurozone, with the latest economic data, it looks like the continent is finally exiting stagflation. And the Italian economy is looking like a bright spot to a certain extent. Do you see this momentum continuing? Do you see that strong enough?
Well, I think obviously Italy has been growing more than the European average, has had an inflation rate lower than the European average. We think this year we are going to grow at 0.6% in Italy, moving to over 1%, 1.1% next year. That should be beating the European average. But don't forget that Italy for us is 45%. The rest is primarily Central and Eastern Europe, Germany, Austria. But especially Central and Eastern Europe is growing much, much faster. So the opportunity for us is to crystallize on that and deliver more than would be expected, because there is a tendency to associate us only with Italy. And in fact, we're not.
Well, I was going to ask you about that because, of course, you did this deal with Alpha Bank to grow your business in Romania. Is it a blueprint for you of how you might want to operate going ahead in Central and Eastern Europe, potentially?
Well, I think we go back to the basics. For us, the main objective is to continue to improve the operating performance of our bank, and we think we have plenty of runway in the next 3 years. The main objective is to having a model that allows us to provide investors with outsized distribution without denting our capital. Now, that model can accelerate or be accelerated by targeted acquisitions where we can apply the same model to what we acquire at the right price. So what we've done in Romania is a bolt-on acquisition in a critical market in Central and Eastern Europe. Makes sense. Could we replicate it in other markets? Absolutely. Do we want to? Absolutely. In the specific case of Alpha Bank, I think it's a little bit more, let's say, it's a little bit different from many of the others that we could be doing, in as much as we have combined that with a partnership in Greece, and which is well ahead of plan at the moment, and where we are testing the quality and the strengths of our factories in distributing through third parties. And Alpha Bank is very happy about that, and I think that allows us to also look at other ways to grow our top line by providing our factories to third parties. And so we may do some of those as well in the future.